Welcome again, everybody. This is Blake Davenport on the LMTR podcast. I'm here with Brad Lamesdorf, a seasoned portfolio manager here to talk about hot topics and relevant issues in the world of investing and the stock markets. Today is Friday, March 24th, 2018. This is episode 2 of a series of mini episodes to come. And we're excited to bring you these podcasts with some of the most seasoned and brilliant minds in the financial world like Brad. In this series, we're going to continue to talk about meaty topics relevant to the financial markets that investors like you want to learn about and gain knowledge from. We know our listeners' time is valuable, and we want to add value to your time spent with us. Brad, thanks again for joining us. I've known you a long time, and I'm so excited for the listeners to be able to hear a little bit about where you're coming from, and because I'm always just fascinated by the depth of your knowledge and your insight of the markets, and I appreciate you being here again.
It's been good. How are you doing?
I'm doing great. Just excited to continue with this journey that we're on, because it's really for me it's been an education, and certainly to the listeners, I know they're very interested to learn more. So today I want to talk about a few things. One of them is just kind of a definition of a short squeeze. A lot of people hear about them. I certainly I've always heard about them, but I've never quite understood them. And how can a retail investor find and actually participate in a short squeeze opportunity?
Sure. So to begin with, a short squeeze, so short sellers are anticipating that whatever they're shorting, no matter if it's a commodity or a stock, something listed on an exchange, they are anticipating the stock to sell the stock now and buy it back at a lower price, which would cover their entire position out. So they would have a no position on at the time. When you are short a stock, you get the depreciation is a profit, and the appreciation is the old negative column. So you're losing money if you're wrong, and whatever you've shorted starts going against you. Sometimes in the marketplace, we talk about psychology from time to time. Some people just get so down on a company they think they're just going to go absolutely bankrupt. But the fact is, when companies do get in disarray, they may be in disarray, but they may have so many assets that the board of directors hires a new management team. They come in, they clean up the mess, they possibly buy another company, they sell some units, they restructure, and they come out a whole new company, and the short sellers weren't really anticipating that. When a large group of investors are short the stock and it starts improving, sometimes they've shorted so much of the whatever is outstanding that they have a hard time physically bringing it in. It's more mechanical. So they physically have to buy the stock. If they're unable to cover the large positions, they have to keep pushing the stock higher and higher to find somebody that will eventually sell. And when you put yourself in that position, that's when you're involved with a short squeeze. When the short seller knows he's wrong and he's just having a very difficult time covering the position due to the fact that his position is so big relative to the size of the company.
Wow, talk about emotional. It sounds like in that instance, when that squeeze begins to occur, it becomes kind of a run on the stock to try to cover your position.
It totally could. There are some stocks that I've seen that literally, while they may be good companies, I don't think they're this good. And literally, they would go from $10 and $15 up to $40 and $50 within inside of a very short period of time. I can remember in the internet days, certainly, where there were plenty of crummy companies that would just change their name and say they're going to start doing something internet related. the stocks would jump and really hurt some of these short sellers almost overnight. I mean, you can just imagine if you short a stock at 8 and you wake up and it's at 16, you've lost 100% of your investment. So it's pretty rough.
Wow, sounds like you could get really trapped.
But for someone who's looking for that opportunity to buy long a security, it makes for an interesting long idea, just because the power of the short seller and him has the ability to have unlimited loss potential on the other side of you works to the long's advantage. So it can be a very powerful theme when you can find enough stocks to create a portfolio.
Brad, switching over, what are the key metrics and variables or indicators that you would recommend or you look for, and that investors that they can use to help them make decisions to investing in a stock, long or short? Well,
I think there's lots of different things fundamentally and technically that have to be in place for you to execute your investment. But it's probably really good to learn a little about how companies earn their money, make sure that it's a sustainable model, and make sure it's a business that isn't going to disappear overnight. That's probably a really good place to start. I'll tell you a quick story. There's a company called BlackBerry. They used to make phones and compete against Apple. They completely blew it, lost the whole business to Apple pretty much. And, underneath the surface, the company is now, all they do is cybersecurity stuff for protocols with instant messaging, and they just did a deal with Microsoft, and they've turned themselves into a internet software security company, and totally changed businesses, but used their similar assets that they had, just used it in a different way. So there's lots of interesting turnarounds out there that are occurring all the time.
Well, I know you're not giving investment advice, but it's sure interesting for a guy like me to try to where do I begin to really understand what is a good stock, long or short. That's very helpful. If you actively manage a portfolio by changing the asset allocation, how do you determine what asset classes are good, bad value propositions?
That's a great question. Traditionally, sometimes we'll have a very large macro view about something. Other times it literally is more of a stock-by-stock basis, and it just so happens that we find a lot of stocks within a specific area that maybe are moving in a similar fashion. REITs, for instance, tend to really move, in lockstep with each other for the most part. So it's an area where if we started to see the sectors move in an accumulation orientation, meaning we saw big institutions coming in and starting to buy the stocks, we'd probably start researching the area more than we normally would. But we're kind of a stock by stock kind of group. We don't really sector concentrate much.
Got it. Well, I tell you what I've had a real difficult time applying any type of key metrics or understanding good or bad value propositions is March Madness. My brackets are completely blown to smithereens.
I'm sorry to hear that.
It's one of the giant killer seasons of all seasons, but my Tar Heels were eliminated right away. Anyway, Brad, thank you. It's always great to have you, and great to have you back, and thank you for your time today on the LMTR podcast.
Thanks so much.
To our audience listening, everybody, thank you for joining us today. If you'd like today's episode and you want to stay informed and in the loop with new episodes as we produce them, please subscribe, review, and share on iTunes and lmtr.com. Have a great and productive day.